This is Pranav Rao from Smartkarma, and I'm pleased to have with me Arun George to discuss the recently announced privatization of Dongfeng Motor, that's 489HK. Arun, thanks for your time today on the 28th of August. Could you briefly introduce the company and the terms of this privatization offer?
Hi Pranav, thank you for this opportunity. Dongfeng Motor is a state-controlled car maker which primarily sells passenger and commercial vehicles. It has been listed in the Hong Kong Stock Exchange since 2005. Now, the privatization offer is by the controlling shareholder, Dongfeng Motor Corporation, which is controlled by SSAC. The offer comprises two components. First, a cash of 6.68 Hong Kong dollars per share, and second is a distribution of Dongfeng's almost 80% shareholding in Voya, which is a premium electric vehicle brand, back to shareholders. Now, Voya shares will be subsequently listed by way of introduction in the Hong Kong Stock Exchange. Therefore, the total estimated offer value is 10.85 Hong Kong dollars, which is a whopping 128% premium to the undisturbed price. Now, in my view, the privatization is strategically sensible because it solves two issues. One, it aligns with China's plans for merger and restructurings in its state-owned auto sector to really consolidate the industry and boost its competitiveness. And second, it eliminates the historical holding company discount in Dongfeng by firstly separately listing the Voya, which is the primary growth driver if you look at the numbers, and second is to delist the legacy slow growth internal combustion business.
Got it. What value does the independent financial advisor ascribe to Voya, and how do you assess that value?
Right. This is quite interesting because Voya is currently unlisted. So the board appointed Somali Capital to determine fair value, or appraised value as you call it. Now, Somali valued Voya based on relative valuation methodology, which resulted in a midpoint valuation of 11.735 Hong Kong dollars per share. Now, I like the approach, but my view is a key issue with this approach is that it was backward looking, as it was based on Voya's 2024 numbers. Now, this is an issue, particularly as Voya is fast growing. For example, its units shipped in the first half of this year grew 88%. Now, the way I look at it is if you assume that Voya's revenues increased 50% in 2025, the fair value of Voya, again using relative valuation, could be 30 to 40% higher than the appraised value. Now, I've been asked by some readers, okay, what's the risk in this approach? And the key risk for me in this approach is that price discounting in the Chinese EV market remains intense despite the government's best efforts to rationalize competition. So because of the intense price discounting, there could be a chance that down the road, it could result in peer multiple compression or declining revenue growth in Voya, which is a risk because the vote is quite far off, I estimate, in February 2026.
Got it. Understood. And maybe just to expound on that, what are your estimates for the timeline for the deal overall, and what key risks do you see to deal close that arbitrageurs should be aware of?
Right. There are two milestones I think ARBs should be looking at for the deal to be completed. One is the satisfaction of the precondition, and second is the shareholder vote. Now, the satisfaction of the precondition, which is really primarily Chinese regulatory approvals, is low risk as the offer is controlled by SSAC. Therefore, the key risk in my mind is two things. First is the timing of regulatory approvals. The precondition's long stop date is 10th of July 2026, which is an indication that approvals could take a prolonged amount of time. The second is the shareholder vote, which could be a risk because Westwood Global Investments holds a blocking stake. Now, Westwood is a long-term shareholder, and its last transaction was way back in 2017. So that suggests to me that the holding is a legacy holding, and Westwood is likely to be supportive of the offer because the terms are quite attractive. Also, I would imagine that the financial advisor would have sounded out Westwood before the offer was announced. So in terms of, Pranav, your question on timing of the deal, my expectation is that the precondition should be satisfied in January of 2026. The shareholder vote, which is the H class meeting, should be held a month later in February of 2026. And if all goes well, the vote passes, the implementation and payment should be made in March of 2026.
Got it. Well, thanks for the call today, Arun. And listeners, check out Arun's coverage of Asian special situations on Smart Karma and tune into our next Smart Call. Thank you.
Thank you.